I just want to, I'm so glad to see many. Many of you are recurrent sort of participants in our event. My name is Magnus Dahlqvist, and I'm a professor of finance at the Stockholm School of Economics, and one of the faculty here, and a researcher at the Swedish House of Finance. So we thought we'll start with asking the audience, you, a few questions. So please take out your phone, or maybe you have a smartphone or iPad or something similar. And you simply log into the website, www.menti.com, and then it has a code 866654. We will have a few questions, and the first one, how do you relate to private equity investments? Are you a general partner, limited partner, academic, other? All right, it seems like we have a slight dominance of academics here tonight, in the afternoon, but in the other, I would think there would be a lot of curious potential private equity investors. And then we have both GPs and LPs in the audience. So this is the question about the current market situation. Or how do you perceive the PE market? After periods of high fundraising, PE does poorly, and you can agree or disagree. So 17 out of 38 agree, 10 disagrees, and some prefer not to answer. There's no don't know. Let's move to the third question. So how do you perceive the current market situation? How will PE perform over the next 12 to 24 months? Better than the last 12 months? About the same as the last 12 months, and somewhat worse, or a lot worse? So split between about the same as the last 12 months, and somewhat worse than the last 12 months. So this is a question heavily related to today's seminar. What challenges do limited partners face as they commit to private equity over time? And these are questions related to fixed allocations or time-varying allocations, and what will be something that you have to consider when allocating. And by the way, multiple answers are okay. So it seems like we have a little bit of everything. We have internal allocations of capital, thinking about reputational costs, and the risk of being shut out of subsequent funds. And with that, I thank you for participating in the Mentimeter, and we'll actually start with the with the actual talk and the seminar. All right, so the idea for the afternoon is that we will have a presentation, an academic study, and then after that we will have a panel discussion. And we start with the speaker, who is David Robinson. He's a professor at the Fuqua School of Business at Duke University, but he's also a long-term or recurrent visitor to Stockholm, both at the Swedish House of Finance, at the Stockholm School of Economics, and he's currently a visiting professor, Persson professor related to entrepreneurship and I guess private equity. So David, please come and join me, and look forward to hear about, can investors time their exposure to private equity? Please.
Thank you very much. Thank you. I'm really glad that software you were using is not the software they used in Iowa to tally the caucus. Otherwise, we'd still be waiting until tomorrow to get an answer about some of these questions. I'm really glad to be here. So I'm going to give a brief talk that's going to cover some material that is in a paper that bears that name. And I want to be fair. Before I do anything else, I want to be fair to my co-authors who did almost all of the work. This is joint work with, these 17,000 other people. Greg Brown, Bob Harris, Wendy Hu, Tim Jenkinson, some of you may know from Oxford, Steve Kaplan from the University of Chicago, and myself. This is, you can download the paper that I'm going to talk about today here at this website on SSRN, but I'm very happy to tell you that it was recently accepted at the Journal of Financial Economics, so hopefully you'll see it in print soon enough. The reason why there are all of us on this paper is because we're part of, we're basically the academic advisory board of a group called the Private Equity Research Consortium. And one of the big challenges in private equity research from an academic standpoint is to be able to study it empirically, because the data are hard to get your hands on, because guess what? It's private. So we have collaborated with an organization called the Burgess Group. I don't know if you guys are familiar with the Burgess Group. What they do is they provide, among other types of analytic services, they provide a lot of back office accounting for limited partners. So what that gives them visibility on pretty much the entire private equity market, because they track the cash flows that go back and forth between limited partners and general partners. And so after a lot of coordination, we've been able to have an embedded researcher, that's Wendy Hu. She works with us, but she works at the Burgess Group. She's able to see all of the de-anonymized data, and she can run analysis, and then we take that out of Burgess in an anonymized fashion. And so what we do at the Private Equity Research Consortium is that we basically act as gatekeepers for this data for other people in academia, with the hopes of promoting our understanding of how private capital markets work. So that's just a quick plug for my colleagues at the Private Equity Research Consortium. The data that I'm going to draw from today come straight from Burgess and are an example of the kind of work that you can do by coordinating with us. So this question, can investors time their exposure to private equity? Think about timing your allocations to private capital markets. A lot of times people are worried about allocating capital to private equity at times when historic fundraising levels have been high. And does that sound familiar? I think we're kind of now in a situation with high multiples, high equity market valuations, dry powder and all-time high. These are signals that tell a lot of limited partners that maybe it's not a good time to allocate fresh capital into the asset class. And in fact, if you were to run a regression where you were to take this vintage year's aggregate fundraising level and relate it to sort of average performance of funds raised in that vintage year, you'd find a pronounced negative relationship between subsequent performance and current fundraising. So those of you who said, so that's one correct answer for I guess the third Mentimeter question. about the relationship between performance and fundraising. But those of you who preferred not to answer, you also got the question right, because this is a regression where I'm using the internal rate of return, the IRR, as my measure of performance. That's an absolute performance measure. The problem is that private capital markets and public capital markets move together. And so if I switch, and so, so Per Stromberg over here has got very similar results from a paper he did a number of years ago with Steve Kaplan. This is a well-established result, that there's a negative relationship between absolute performance and current fundraising. But if you think about the relative performance of private equity relative to what you could have earned at the same time in a public investment, this result attenuates dramatically. So I'll be talking a lot about a performance measure called the PME, Public Market Equivalent. And those of you who've been to our talks before have probably heard Per Stromberg and I walk through this. Basically what the PME does is it's a comparison of what you earned in a private investment to what you could have earned in a public investment had you invested at the same time. And so this PME is a number that'll be, we'll look at some numbers in a few minutes, and when you're looking at a PME, pay attention to whether the number is above 1 or below 1, and that'll tell you whether you outperformed the public investment or underperformed it. But in general, this tension between current fundraising and subsequent performance is dramatically attenuated when we think about what your alternatives were in the public market, and that's going to play a big factor in what I'm about to show you. So let me just tell you the bottom line so that if you want to get back on your cell phone and tend to work emails and stuff, you can, or fall asleep or just sneak out and get another coffee or whatever, you feel free to. What's the bottom line here? Can investors time their exposure to private equity? Not really. It turns out it's much harder than you would think. If I were just to stand here and look at this slide, it seems like there's an obvious strategy. Why don't I not commit capital at times when capital commitments are high in the market? It seems like I could avoid some of this dramatic underperformance. Well, the problem is you control when you allocate capital, but you don't control when the capital is called, when the capital gets deployed. Your capital commitment is only giving the general partner the investment capital. You don't control how they make those investments and when those investments come back to you. And so really what I'm going to show you in the remainder of the talk is I'm just going to walk you through the mechanics of how we were able to arrive at this conclusion. But the conclusion's fairly simple. The gains from market timing are rather limited. And the reason why they're so limited is because it's relatively difficult to unwind through your allocation strategy, through your commitment strategy, the general partner's investment strategy. So I should, before I go further, well, I'll go a little further. To get into the details, we're going to compare 4 different types of timing strategies. We're going to look at fixed allocations to each vintage year. So I'll call that's going to be my baseline, and that's going to be a constant dollar amount in every vintage year. I'll come back to that in a second. But that's going to be my baseline. And when I say you can't do like the benefits to market timing are really modest, what I mean is that it's actually quite difficult to do better than this. But we'll compare that with a couple of other strategies. Some are strategies that you guys could not undertake if you wanted to because they require foresight. They require foreknowledge of what will later happen in the market. But I'll show you some strategies that require foresight just as a way of kind of putting bounds on what you might possibly hope to achieve if you could look ahead and see into the future and see when it was going to be good to be out of the market or not. We'll also look at some strategies that are investable in a statistical sense. They don't require you to be able to look ahead, but they might be organizationally challenging for you to implement inside your organization. In other words, for example, they might require very large swings in the capital that you're allocating in one vintage versus another so large that you might find yourself shut out of the market later on, or so large that you'd have a large staff that was sitting there with nothing to do for the 18 months you sat out of the market waiting for things to come back. So these are, statistically investable, but honestly not that practical strategies. And then we'll look at a set of strategies that are both feasible and potentially practical. And what we're going to find is that even some of these extreme strategies don't do a lot better than this. Now, I should pause here, though, and say that the vast majority of limited partners in the market do not do this. If you think about a limited partner who follows a strategy of sort of keeping your portfolio weights roughly constant over time, let's just keep it simple. Suppose I have two investments, a public investment, a private investment, 50-50 weights. As the public market goes up, I've got to increase my capital allocation to private equity in order to keep the weights balanced at 50-50. That means that I'm allocating in a pro-cyclical fashion. And I just showed you, or I just told you at least, that public markets and private markets are highly positively correlated. So the kind of simple strategies that many limited partners pursue of trying to maintain roughly constant portfolio weights throughout the market cycle lead to capital allocations that are in fact quite pro-cyclical and deviate substantially from this. And I'll show you that you could improve your situation by trying to return back to something closer to this. So let me walk you through a little bit more of the details. I don't want to get too deep into the weeds with this, but let me not bore you with all the little tiny mechanics. I'll just give you a summary. So we're going to try to look at a variety of different strategies, and to keep everything on equal footing, I'm just going to assume that there's $100 of capital to allocate each year. And the question is, how am I going to allocate that? The fixed allocation will just give $100 per year, regardless of what's happened in the past or what's happening currently. Then I'm going to look at some strategies that require foresight. I'm going to say, let's take the $100 and let's go double or nothing. Let's go $200 in years that are above the historical median performance, and 200, and zero in other markets. Or let's do the opposite and let's allocate zero in the best half of the market and $200 in the worst half of the market, and see what kind of variation we get there. Now, obviously, if we're talking about what's going to happen in the next 20 years, I don't know which of the next 20 years are going to be the best market. So you can't do this, but it's a good reference point, looking back in historical data. Then we'll do something like this that's implementable. We'll use a 3-year rolling average of past performance and allocate that either in a pro-cyclical or counter-cyclical fashion. So if markets are going up, I'll be increasing my allocation in this one. And if markets are going up, I'll be decreasing my allocation in this strategy. And, well, these pro and counter-cyclical strategies give you highly varied capital allocations over time relative to what you would get with a fixed proportion. Now, again, to go back to our colleagues at Burgess and give them another plug. So we're going to use the complete transaction history available in the Burgess data, which is going to give us 1,826 buyout funds and around the same number of venture capital funds that were raised between 1987 and 2016. Sorry. The last year they were raised was 2013. And then we'll follow 2013 vintages out 3 more years. And so the numbers that I'm going to show you are numbers that are net of fees and carried interest. So these are this is the actual net of fee performance that the limited partner would have received. And I guess I should say something here. Very few limited partners allocate only $100 per year on average to private equity. So you should think about this, if you want to think about the scale here, I mean, in terms of like practical implementation, think of it as say 100 million or whatever. But the reason why we're working with a small number like this is because we want to sidestep any issues that we might have to face if we were making such large commitments that we were, exceeding the amount of capital that was being attempted to raise in that market. So we're thinking about ourselves as just a marginal investor in this market. Yes, sir.
Are you equally weighting or value weighting?
Yes. We'll do both. He was my advisor in grad school, so I get to make fun of him in public. Here's the punchline. And let's the story is more or less the same regardless of what type of performance measurement you look at, but I really prefer to look at the PME, the public market equivalent. If we follow this fixed annual commitment strategy, we're going to have a PME of 1.15. And so the way to think about interpreting that number is this number, technically it's the ratio of the present value of what you received from private equity to the present value of what you put in it. So it's saying that $100 in present value of capital commitments generated $115 in present value of distributions over the 10-year life of the fund. And we're using the market return to discount it. So that's what you got with a constant dollar strategy. Suppose you could look into the future. You could have beaten that by you could have gone from 15% to 25% if you doubled down in the best PME years and stayed out of the worst PME years. Suppose you increase your capital allocations in a pro-cyclical manner. So when fundraising has been going up over the last 3 years, you're increasing your fundraising. You would have had performance that was below the fixed commitment strategy, but not a ton. If you'd pursued a counter-cyclical commitment strategy, you would have exceeded the fixed annual commitment strategy, but not by a lot. And there are different ways to think about scaling. The story that you get is more or less the same. This is buyout.
Sorry,
yeah, please.
You said you keep an eye on above one and below one. So above one means that it's better than the public market.
That's correct. So so we're talking about a number that think about what's happening here, and this gets kind of back to Per Stromberg's question. We're taking an average over each of the fund commitments, and this number is being calculated over the life of that fund. So so we can do that on a value-weighted basis, attaching more weight to larger funds, or we can do it on an equally weighted basis. But this is something that to get that number, we're looking back over a 40-year time span, and we're averaging up the event histories of each of the funds in question. Yes?
Given that fundraising has been increasing over the last 30 years, isn't there a lot more pro-cyclical time periods than counter-cyclical? How many counter-cyclical 3-year periods when fundraising has been shrinking has there actually been?
Yeah, not nearly as many as the pro-cyclical, you're right. And what's going to, one way to think about your question is to think about, so here are the buyout numbers, and let me show you the venture numbers. And in particular, pay attention to this. So in buyout, pro-cyclical is bad and counter-cyclical is good. And venture, you see that the opposite is true. And the reason the opposite is true is it gets to the observation you're making. If you tried to allocate capital to venture in a counter-cyclical manner, it would end up taking you out of the market through some of these protracted, long periods of escalation, like in the 90s, over the last 10 years. And it would have caused you to be heavily in the market during these periods of sharp contraction. And it turns out in venture that just completely unwinds the benefits to being sort of just in for a fixed period, a fixed dollar amount each year. So you can see you should look with some skepticism at these numbers as a practitioner, because I can pretty much guarantee you that you can't get a PME that high allocating to venture if you started now, right? This is data going back to 1987, and I'm assuming that I was able to invest this $100 that I'm investing in venture. I'm able to spread it across every fund that was being fundraised that year, whether I do it equally or proportional to the size of their commitment. And so what that means is that I'm able to get into the very top venture funds, right? These calculations are assuming that I have perfect access. And in the process of trying to get this paper ready for being accepted to a journal, we did a lot of robustness checks where we tried to say, suppose you can't get into the top X% of funds, what does that do? Well, it makes these time waiting attempts even worse. Let me see. How are we on time? Okay, I'll finish early. So I've shown you strategies that involve changing your weights over time. We also tried to play around with different ways of thinking about allocating capital. So here's your value weight versus equally weighted answer pair. The numbers are a little bit better value weighting in both, but they're largely similar. We played with, so your idea about how do you think about the fact that in general the market has been growing over time? Well, if you just have a growing annual allocation, and so you go from $100 to $105 to $110.50 or whatever, those are the performance numbers you get. They're largely similar. Suppose so these constant allocation strategies, they raise, there's some wrinkles here that I kind of brushed under the rug in the interest of time. What do you do with the distributions that you get? Do you put them in an index? Do you notice if I'm following a fixed annual strategy and I'm reinvesting the distributions I receive back into private equity, suddenly, lo and behold, I'm going to have a highly pro-cyclical commitment series. So I need to think a little bit about how I want to manage those distributions. If I take them and I reinvest them in an index and I add that back into the return I'm earning, that's what happens here. The performance is much worse in venture. If I restrict attention to more seasoned general partners, so general partners who've had 2 or more prior funds, you can see that my performance improves relative to just a fixed annual strategy. And conversely, if I look at new GPs, I'm going to find that they do worse on average than the general market. And here's what you get if you cut on size. Slightly better performance, well, a lot better performance here, and slightly better performance with buyout. So we played around with some things. I've been showing you numbers that assume that I could take that $100 and spread it into every single thing that was being raised in a vintage year. What if you can't access every single fund, but you just access a random number of funds that are being raised that year, and you can think about varying how many funds you can access? Well, the central limit theorem kicks in, and you get results that kind of center around what I've shown you before, but spread out more or less depending on how many funds you're able to allocate to. So all I've done so far is I've answered. So we started this whole talk. Can you time your exposure to private equity? Answer: not really. But I haven't told you why. So let's try to look at why this is. So let me try to. So the real answer here is that these capital commitment strategies don't tell you anything about when the capital is actually being invested. And so I guess to put it in simple terms, think of it like this. Imagine 3 funds. One's investing capital they raised this year. One's investing capital they raised last year. One's investing capital they raised 4 years from now. An interesting investment opportunity comes along. They all think it's interesting. They don't think it's more or less interesting because their fund was raised 1 year ago or 2 years ago. So underlying changes in the investment opportunity set that general partners face drive their capital call behavior and their exit behavior out of their investments. And that's occurring irrespective of when you committed capital to their fund, up to considerations about investment periods expiring and stuff like that. And so let me try to show you some numbers to kind of put some meat behind that. This is maybe not the best way to see it, especially in the back. But what you see is sort of the broad. So these are the actual contributions, the actual capital calls you face, the actual distributions you've received. And I'm looking at fixed strategies, pro-cyclical and counter-cyclical. And what you can see, just in the back, all you've got to really kind of pay attention to is the fact that these numbers all kind of move together. These numbers on the bottom all kind of move together. So regardless of whether you've allocated your capital in a pro-cyclical or counter-cyclical fashion, you're getting it back at more or less the same time. And that's what's making these PMEs look so similar to one another. Here's maybe a simpler way of seeing it. Here's what we did. We said, let's look at the correlation in capital calls and in distributions to capital commitment strategies that by definition are perfectly negatively correlated. Because what I'm going to do is I'm going to consider the correlation between a strategy that's either in or out of the market, depending on whether the market is X times above the median. So just to keep life simple, just look at this column here. I'm going to compare strategies that are in above median to out above median. And I'm going to look at the correlation in the ensuing capital calls and distributions. So these commitment strategies by construction are perfectly negatively correlated. They have in buyout they have a correlation in the capital calls of 0.39 and a correlation in the distributions of 0.82. So you're committing capital in completely opposite ways, but it's being called at kind of the same time. And it's being given back to you at really the same time. That's in buyout. Now, in venture, you do see a negative correlation in the capital calls to these commitment strategies that are completely opposite one another, which is partly a function of the fact that capital is being called more quickly, I think. And the correlation in distributions is lower, but bear in mind the commitment strategy underlying this has a correlation of -1. So you can see that in both buyout and venture, the calls and distributions, the behavior of the general partner unwinds your commitment strategy. And just as I was able to show you that the returns to timing were stronger in venture than they were in buyout, you can see that the correlations here are much less dramatic than they are in buyout. And that's kind of telling you why that is. So then the final piece of the story is to kind of go through an exercise and say, well, what if I tried to unwind the general partner's behavior? So I see them making capital calls and making distributions. And I could do, so how much value are they creating by, how much am I giving up, or how much am I gaining or losing by delegating the right to call the capital and the decision of when to give it back to that general partner? So we can kind of cut this into a couple of pieces. We can think about, let's start with a fixed commitment strategy. And let's let that be the baseline. And then now let's say, okay, let's give the capital to the general partner. Let's construct a sort of a pseudo investment strategy, a fictitious investment strategy that says, I'll commit capital to private equity anytime a general partner calls my capital, but I'm going to hold it for a fixed period. And so I'm breaking the I'm breaking the endogeneity of their decision to exit. I'm going to say I'm exiting at a fixed point, regardless of when it gets invested. That's one series. Then another series is.
You get NAV when you exit?
So what we're going to do is we're going to compound the. We're going to allow you to earn the market during that. So this fictitious investment that you're making is going to go into the market, and we've run all. So that's going to create the level difference in them. But we've also played around with making it earn basically the PME over the market over that time period. You see what I'm saying? So it's So your capital calls are occurring at the same time. So anytime I'm facing a capital call, I'm going to place it in an index, and I'm either going to earn the value of the index over that period, or I'm going to earn PME times that index to bring those together.
So this is about counter-cyclicality of public market. Or, yeah,
It's about.
right? Because you're saying, oh, it's good to go in the S&P 500 when certain PE funds invest more. Or the one, I don't know what it is actually. I have a hard time driving.
So imagine that the average imagine that the performance. So what's generating the return that that you're getting in the fixed commitment strategy? Some of the return is coming from the choice that the GP makes of which company to invest in. Some of it is coming through the change in the value of the portfolio companies that they're holding over time, and some of it is coming from their choice of when to exit. So I'm going to say, suppose I chose a randomly, I'm just going to make a random investment in a public market at the same time they make a capital call. So I'm not getting the extra that they get through their selection, but we know markets move together, so I'll earn a similar return during the holding period, and it's just that I'm going to get out at a pre-specified time rather than when they want. So there will be a level difference in this number that comes from the fact that they might be choosing better than a random firm. But when I start comparing these indexes against one another, I'll be able to see how much of it is coming from their choice of when to exit versus something else. And so what you can see, so these numbers basically are.
These are all PME equal to one strategy.
Yes, that's exactly right. Remember, we're investing $100 every vintage year. So, and these are quarterly numbers. So when you look at 44.8, that's an average quarterly net cash flow to a strategy that allocates $100 per year, just to kind of keep the units roughly sensible in your head. The other thing that you care about, are what are the correlations here, right? Because I'm generating a cash flow series, and the question is how highly correlated is the series with a fixed holding period to the one that has their endogenous holding period. And you can see that it's actually fairly low correlation. It's lower. The holding period returns are lower than what you would get by actually investing with buyout. But more importantly, the correlations between this index and what the actual index you get is actually relatively low. So a large component of the value that's being created in the private equity investment is coming from the timing of when they exit. Now we're going to break this. We're going to break this down further, and instead of allocating capital to the index at exactly the same time as we're facing a capital call here, we're going to allocate capital to the index according to a scheduled call pattern. So a vintage year, let's say a 2000 vintage, we have different schedules in the paper, but a 2000 vintage might allocate a third of the capital in the first 2 years, another third of the capital in the second 2 years, and the final bit in year 5. So we'll imagine taking our commitment and putting it in the market in exactly that same manner, and then exiting according to a 3 or 5 or a 7-year holding period. And what you can see is, again, the correlations are quite low to what you actually get in the actual investment strategy. And in general, the returns that you get are lower as well. So with that, I can wrap up. So can investors time their exposure to private equity? No. And the reason why is that investing in private equity involves commitment risk. You control when the capital is committed, but not when it's invested. And general partners raising funds in different vintage years have very similar investment policies, which lead to highly correlated returns, and that correlation unwinds any benefits that you could hope to get through varying your commitment. That's certainly true in buyout. The potential gains for venture are greater, but they're probably not achievable in practice. And in fact, I think this is something that I'm interested in hearing our panel talk about, because this has been a dry academic exercise of taking a data set and imagine moving around marginal dollars and thinking about what the returns are. It's very different to live in a world where you actually have an investment team and you're making portfolio allocation decisions where you have to speak back to your constituents and explain to them what you've done. And so I think the complications to varying strategies in practice would complicate this even further in ways that we haven't even considered in the paper.
Sorry, the last piece of analysis you did, is the correct interpretation is that regardless of the vintage year, you can't control when they invest, but I think the conclusion was that they're actually deploying that capital better than you would be able to do if you did it.
That's exactly the conclusion.
So even if a fund raised in sort of a hot period, they will be more clever than maybe you would have been in when they deploy that capital, and that makes up for part of the reason that they are invested. Their hot market.
Think about a VC fund that was raised in 2000.
Right. Because
They're gonna.
the 54.8%
Yeah.
being higher than most of these other things.
Yeah, that's exactly right. So think about a VC fund that was raised in 2000. My index comparison is going to get out in 2003, even though no GP would have exited investments then.
Right.
And that's exactly what's going on.
And if you had a portfolio of about 80 funds, it would be a very, very
your brain will be cooked as an LP if you try to do that.
But it also suggests that you could start a public equity fund that just mimics their allocations to some index when they see GPs making investments, and you would beat the market.
And this would show you that that strategy is not going to work. The numbers that I showed you on the previous slide.
I thought
So-
you had 44 point. Okay.
Thank you, David.
Thank you.
All right. So after this presentation, I would rather hear about these allocations in practice, and we are inviting 4 panelists. Please come up on the stage. So joining David from the left is Natalia Fontecha from StepStone. Then we have Roger Johansson from Caneo. Then we have Christina Brinck from AP6. And then finally Bengt Hellström at AP3. So we have a lot of experience in private equity investments, both LP and GP experience. And I thought I'll start with a few questions, and then I hope you can take it on and make something good out of it. I think I'll start actually with the next to me, where I have the experience working at both AP3 and AP6. So Bengt, how do you think about the timing of allocations? You have both a private equity or portfolio and a public portfolio. Whereas Christina, I'll invite you as well. You only have the private equity portfolio and not the public portfolio. So Bengt, why don't you start?
Yeah, sure. To start with, we're a pure fund investor because we're not allowed to make co-investments. So that's sort of one thing that I want to make clear from the beginning. Our view is that it's not possible for an LP in a fund to time the market, because it's really the GP that make the investment decisions. We make a decision to make the commitment up front, and then sort of in the coming 3 to 4 years or something, the GP will invest it. So that's kind of our view and the way that we have treated it all the time when we have been investing in private equity.
So how fixed is your fixed allocation to private equity?
I would say in general it's been related to the size of the fund overall. Also worth to mention is that historically we've had the legal restriction that we have to relate to, and that for us caused some problems around the financial crisis, because we went above that level, and I guess that's one other effect of being a fund investor, because then we couldn't re-up in some of the funds that we would have liked to do it, and then in some instances you have a difficulty coming back into those funds.
So let me see. So during the crisis,
So
when the public market fell,
Yeah.
then suddenly you had a little bit more than,
Yeah,
or close to what you were allowed to have in your portfolio.
Actually, even more than what we were allowed to have, and I think the access issue is very important from an LP's point of view, and therefore it's also important to be sort of consistent in terms of making your commitments.
So in the Mentimeter questions, we had something about worries about getting into the next sort of number fund. Was that a concern then?
Yeah, to a certain extent, if it's well-performing GP, obviously you want to continue to invest with that GP.
Christina, you don't have the public equity or other asset classes in your portfolio, so Is it different for you guys?
Different, yes, it is. We are an evergreen structure, and we invest both in funds and we do co-investments. We work in buyout and the venture segment of the private equity market. The co-investments is only done in the buyout part of the market. What we see as difficult things are that we are a closed fund, so we need to have liquidity at all points in time to fulfill the requirements from the managers that we have committed to. And we try to navigate in the market by constant commitments to funds. We reinvest the gains, so we have like 10% increase in commitments each year because we get cash flow back. And we try to work with secondaries because that can help us get money back a bit earlier. And also they have a different J-curve compared to primary commitments. And we try to time the market a bit with the co-investment because that is kind of a balance with the liquidity, and we own the decision on when to do co-investments. We do not own the decision on when to sell co-investments, but at least when we want to deploy more capital. And we have also thought a lot about the venture part of the market. So over the last 6 years, we have increased the number of managers because we have too concentrated portfolio. So we have a more diverse portfolio in venture today. But I think it's a lot about manager selection, and in this selection you have to look into the details and see the investment strategy, when a manager is allowed to use the capital, if there are limitations like maximum 30-40% during 1 year, for instance, to see if it's an investment period that are not too narrow, so to say, because then you really get, you could have problems with vintage. So it's fund selection and really try to find the best manager in their own segment.
So Natalia, I'm turning to you now and thinking, how does your portfolio look like? And you're doing both venture and buyout?
Yes, so StepStone is a global private markets platform. We invest on behalf of clients, so we're technically an advisor or consultant. We allocate roughly $20 billion a year on behalf of our clients into private markets. So we help our clients build their portfolios, and the one thing that we always say to them is never try to time the market. So as practitioners, we have the practical evidence that it's not a good strategy, and it's always very helpful to have academic data that backs this. So we invest across all strategies in buyouts, and we invest in venture capital. And as Christina was mentioning, for us, one of the key things to emphasize for clients that are investing in private equity is that rather than timing the market, which is nearly impossible, as we have seen from an academic perspective, just make sure that you focus on the right selection of managers, because it's even more important than in public markets. The spread and the dispersion between top quartile and bottom quartile performance is bigger in private markets than in public. And also rely on the right portfolio construction, because there is a lot of gains that can be made in performance if you build your portfolio in a balanced and diversified way.
So it sounds to me that there's less sort of diversification over time, or that there's diversification to do over time. But can you relate to the other part of the portfolio construction, maybe on geography or industry?
Well, that very much depends on what are the constraints of the investor. Some investors, public funds especially, seem to be a little bit more constrained. But if you were in a free environment and starting from scratch, we always try to balance funds, investments with where the market is the biggest. So obviously, U.S. is an area where there is the most sophisticated and the biggest investments. So we have a big tilt to the U.S. We obviously also have a tilt to Europe and Asia, but we try to really make investments that are risk adjusted. So it also goes back to what the currency of the investor is, because sometimes an investment that is in absolute returns good in the local currency can go back into your own currency with all of the gains erased. So we try to do balanced portfolios across geographies with a focus on the US, Europe, and a little bit in Asia if the plan or client allows for it, and then invest across a variety of strategies. We as investors try to avoid mega large funds, but some of our clients need to go into these funds because of their size requirements. We tend to think that better opportunities are found in small and medium type of buyout funds. And venture capital is a completely different story. There you have, it's another animal. But yeah, in essence, it's just invest across a variety of strategies and geographies.
Roger, we noticed David's, and you said this is a paper portfolio. This is not a paper portfolio. It's not an actual strategy in the academic world, looking at the true cash flows, though, both calls and distributions. But how do you think about the timing?
Well, first of all, I mean, it takes quite a lot of time to actually build the portfolio. It takes several years. You have to find the right managers. You have to stay with the managers for some vintages too, and you can't just continue to find new GPs to invest, because then you will have a severe problem in a while. So you will actually have to do exactly what Natalia is saying. You have to go with the right ones. You have to stay with them for a while. You have maybe to do 2 or 3 fund vintages with them actually until you have a portfolio that starts to work for you. And then when it starts to work, it will start to send you money back. So that will take you about 8-9 years or something until that actually happens. So you have to live the first sort of 5 to 6 years in more or less darkness until you know whether you have done good or bad. And so it's you have to have a strong heart or a very, very, very good board that believes in what you're doing actually. But then I think I love these academic papers because they actually show things that you can't do in the real life. Sorry, Per. David. But it's more like that is actually good because that means that as a practitioner, you have to understand that you actually have to find your way of working with the real world, because you can't really do what David was showing here with for instance the last couple of slides that I had a hard time to actually understand. But it's so good that they actually do this, because they showed me that you can't time, because of even if you do academic analysis on just the results, not putting any kind of people or environment into it, just putting it in, just doing the analysis on numbers, it still comes to the same conclusion, and that makes me feel really good actually.
So we are in a situation with, it seems like a lot of things are expensive, both public and private market maybe. A lot of capital. Investors are shying away from fixed income with very low interest rates. Is this the right moment to go into private equity, Roger?
It's always the right moment to go into private equity.
Especially with you.
Especially with me. As long as you are going to be there for a while. If you think that you will just go into private equity in any way, and you try to be, you'd like to be there for like, 2, 3, 4 years, you shouldn't, because I don't think that will ever work actually. So you have to take a strong decision and jump into the water and start swimming, because that's where you have to continue to swim in the pond for quite some years. And I'm really sure that we have with all the trends that we see in the market now, with all the technology development, you were referring to the emerging markets, very important, of course. There are so many places, still so many investments to do. So absolutely yes, but I fully support Natalia's point on and I'm very, very suspicious to mega funds, because they are a different animal. But I do understand that some LPs needs to do those guys. But I also prefer the smaller ones. It's more interesting.
So feel free to jump in, follow up comments. Bengt, you mentioned the downturn and the increase of the private versus the other asset classes. Do you have to fight with your colleagues about getting capital to invest?
No, it's actually the simple answer. But I mean, it's still a tiny part of our asset allocation, and I think we have proved over time in terms of the returns that have come out of this asset class that it's not really any internal discussion around it. So I think everyone feels sort of comfortable to continue to invest in that space. And with the market downturn, the challenge, I mean, you asked if is this the right time to commit to funds when you have high valuations in the market and so on. Well, we don't control when that money is actually invested in the market. So the most important thing is to choose the right GP. I guess that does the timing for you.
Bengt,
so I let David follow up. Yes.
I just wanted to ask a question about this managing the rebalancing in the downturn, because you're describing a situation where there's a huge decline in public markets, and so that sends the value of your public equities down, which sends the relative proportion of your private equity too high.
Yep.
Seems like there's a simple resolution to that problem, which is to get the GP to write down the assets under management by saying that, so if they said, look, our AUM is we're going to use some multiple out of the market, and we're going to value, then suddenly magically you wouldn't have to do anything.
I guess that
surely someone smarter than me thought about this a long time before.
Yeah, but I mean, on the other hand, you have sort of a quarter delay in the reporting, so that's one complication, and then I think you don't at all see the same volatility in terms of valuations in the private market, neither on the upside nor the downside. So those things taken together, then it's kind of hard to solve it by doing it the way that you say. And so I mean, for us, the end result was that we were basically out of the market for 2 years in terms of availability to make new commitments, and that kind of caused the second J curve. You can say that we, in a way, just gotten out of. So.
Yeah, maybe the fact that GPs actually get a fee on valuations has some sort of impact on
I've heard people say that before.
on taking down valuations. I don't know if it's true, but it might be actually.
Is it possible to ask the GPs not to call any capital?
Pardon?
Would it be possible to ask the GP not to call any capital in that situation?
I think we all have, and I support Bengt. I mean, I was at another large institutions here in Sweden at that point in time at Scandia, and our experience was that there were no capital called during the downturn because the GPs didn't want to call capital, because that's actually sort of bad for them, because they will call capital that is not really used for anything, that actually have a negative impact on their IRR. So that's why they don't call. That's a big thing with private equity. The GPs don't have to do. They can sit on their hands and just wait.
Which goes back to the manager selection, because you have to
Yes.
make sure that you choose the manager that it's not going to be rushing into deploying capital, even if it's not a good time, but also a manager that has a solid deal flow, so that even if it's a hard environment, they're going to find investments that are worth investing. And there is multiple data that shows that while in a downturn market, the amount of bad deals increase, there is also good deals that are to be found in a difficult market environment. And that's true for public markets, and that's true for private markets, and it boils down to manager selection.
So we can allow for some questions from the audience, and I guess we start with our own pair.
Okay, thank you. There seems to be two strategies that you could implement that could make you more counter-cyclical. One is buying secondaries in down markets when there are a lot of liquidity constraints selling. The other one would be to do direct investments like the Canadians do. CPPIB, I think, did the biggest buyout in 2009 or 10, trying to deploy way more capital when there wasn't much capital calls and things like that. So what are your view on those kind of strategies? Do you think that would improve returns to kind of more passive alternatives?
In a way, I would view that as the possible opportunity to time the market, but I mean, it's not been anything that we can do since we're not allowed to make those kind of direct investments. But as you say, I mean, the Canadians and also some others, I think, were actually quite active during that period. And I mean, as a consequence of the financial crisis, I think there were some LPs that had difficulties because they historically had overcommitted to private equity to sort of deliver on their commitments and more or less giving away their early commitments. So if you were a long-term investor in the asset class, you definitely had an opportunity to make good investments at that point, I think.
But there is a danger to that, and it's in the... Sorry, I'm Spanish. I'm in Sweden. It's terrible for me. So in the U.S. Pre-financial crisis, there was an overallocation of some pensions to funds, and they now, in retrospective and trying to make a big fun of themselves, they call these the days of machine gun commitment. That's all very good and fine if you find the right managers that are into the market at that time, but that can lead to a problem, and it's that you have to allocate money to managers that are not as good because the other ones are full, or you have already spread your money into the good available ones, and so your performance can be negatively impacted just because of you've done a bad manager selection and not so much about the market timing. So it's not a perfect world, but even if you were to...
But even a secondary in a mediocre manager can be good if you buy at a big discount at the Navy.
I mean, on the secondaries...
I fully agree. In the short term, it might be, but it's an IRR thing. It can actually hit you badly later on. But I think, I do agree with you, Per, that, and we did it personally during 08, 09. We did some really extraordinary good secondary deals, but we only bought managers that we already had in our portfolio from others but to very low with very large discount because of the financial crisis. So I think if you do it correctly, it can be really good. But I fully support with Natalia. It's a dangerous thing to think that there are free lunches out there and just buy secondaries.
Christina?
I think it's difficult to do direct investments instead of having more deployed by fund investments during a short period of time, because the reason why the funds don't draw down capital is that they can't find good deals, and the likelihood that an LP can find the good deals in such a market, I don't think that's possible in practice. And if you do direct investments, you have to live with them for quite some time. So after 4 or 5 years, you still have to manage them somehow. So I think it's important to stick to your strategy.
And I would add that secondaries has massively evolved in the last 10 years, partly because a lot of people needed to restructure their portfolios because they couldn't keep up with the allocation, so they needed to sell. And where it was very easy to find big discounts a few years ago, it's increasingly becoming more difficult, and as any arbitrage opportunity, the good managers are trading at near pair or even at a premium, and some of the bigger discounts are either very niche, able to find but are very, very niche, or are just because of the assets maybe are not that big quality. But I would say, as practitioners, if we are advising clients to build a portfolio of private equity, we always recommend a prudent combination of investment in funds, secondaries, and co-investments. Whether that's direct or through funds is a different story and depends on the capabilities of the client and the investment teams they have. But it's a combination of the 3 strategies that bolds for the best possible outcome.
We're happy to invite questions from the audience.
Thank you. Thank you, first of all, to David for a very interesting presentation. A question to Bengt and Christina. I mean, you guys are paid to do what you do, so to say. You do PE and nothing else but PE. But let's say that you were in charge of both the private and the public market at your funds. And you knew public markets just as well as you do PE. Would you still keep a constant allocation to PE, or would you then try to time the markets?
I guess it's for Bengt.
Well, I haven't worked with public markets for 25 years or something like that, so I'm not sure I'm the best one to judge. But if I just compare sort of the level of returns and the volatility of returns in public and private markets, I would definitely prefer to stay fairly constant with regard to the exposure to private markets.
Is that another way to say that you would think about counter-cyclical in the public equity markets versus fixed income?
I pass on that one. Yeah.
Roger, it seems like you want to say something.
I mean, David, you were using data from Burgess here, and to support Bengt's point there, Burgess may have made it's nearly 80 years of comparison of public equity data versus S&P 500, and you can clearly see that private equity market is outperforming public equity in every type of market except bull markets in 30 years.
And where are we now?
Well, I mean, bull markets are very short and very far and few between, so I don't think we have to but we are not in a bull market anymore.
I think this is the only 10-year period, looking back over the last 10, the only 10-year period in which private equity has not outperformed public equity.
Yeah. The market index. Yes.
The market index, that's what I mean.
Christina.
Yes, I'm a bit biased to private equity, of course, but I think the governance model in private equity is very efficient, and I think the managers of today, they are much better than the managers 10, 15 years ago, because it's constant learning within the organizations, and I think they will be even better 10 years from now in how to create value in a company. And I think the relation of an LP having demands on the GP that can have demands on the companies, that's a very efficient way of developing companies. So that's why I would prefer private equity over time.
So there's a question over here.
Thank you very much. Being amongst the youngsters, I guess one thing that I was wondering, you look at your data set, 84, was it starting? 87. It's kind of pre-internet.
Very much pre-internet.
Right.
Yes.
Well, I was just reading up actually when it was invented before. But anyways, so I was wondering.
Pre-flat screen TV.
Definitely mobile phones. So I think as information flow has probably changed a little bit over the years, how do you foresee or how do you expect that your strategy to change?
Who's it for?
Maybe
who wants to take it? David.
I don't have strategies. I just look at other people's strategies. You should ask these guys.
And David, if you look at your data set, have you played with the length of the?
We have a little bit. We like to go back as far back as possible, just because, I could brag about having X number of monthly observations, but it's not really clear that those are all distinct data points. I mean, you kind of have in venture capital, you kind of have the 90s and you have everything else. And so, our results are not terribly sensitive to when you start the data set and when you end it, as long as the 90s and everything after is in it for VC, and as long as the buyout sample includes everything that started happening beginning sort of in 2000. As long as you have those snapshots in there, you're going to get the same conclusions. At least that's what the data say. How you guys think about it is different, perhaps.
Well, I have to say, I maybe I'm biased because a lot of people know that I actually like venture. I think it's a very interesting market, and it continues to be even more interesting and also more important because of the new technology and where actually technology comes into play, and it comes into real processes, real industries. Today we have, of the fintech, of the internet, of course. Now we have the ESG. You have the environment where the venture part will be quite important, actually. So I think I don't say that the numbers will be different, David, but I think it might contain different areas.
I think that's probably right. I mean, part of the reason why my numbers look the same is because I'm averaging over all of these different trends that are happening to different degrees at different points in time, and where you want to pay attention going forward is probably going to be different than where you've paid attention historically, but I'm just kind of smoothing over all of that, which is allowing me to say.
Agree.
Yeah.
The background to the question is also that in your data set, where I am, it looks horrible. It's a small VC fund.
Yeah, right.
There was
Another question over here.
I'm just curious about, you're talking about a high return for the PE compared to the market. And I'm just curious because you're saying it takes about 8 or so years until you get a continuous return. It's kind of illiquid, so the risk-adjusted return might be hard to kind of measure the risk compared to how you can measure, market risk with the standard deviation. I'm just thinking the high return, isn't that exactly commensurate with the risk that you're taking, even the risk that you can't measure?
It depends. What's your definition of risk?
Well, really, I mean, you're waiting long. It's an illiquidity risk.
Yeah.
The standard deviation can't really be measured. You have to wait for 8 years. You're at the mercy of the GP and so forth. I mean, these are a lot of risks, although they can't be quantified. Getting a PME of 115 to 130-ish that might be what you need to have because of the risk.
Yeah. Well, in terms of what we usually account for returns that you should get in private equity, usually people are thinking of at least a spread of 3% over a public market index. That's what usually people expect. I mean,
At least.
they will have their own, but in general, at least 3% over the public markets. And if you cannot get that over time, if you cannot
Actually,
get that-
slightly more than that.
But I mean, your
that we
point is
target.
correct, of course. I mean, because I mean, first of all, you have to get into a mature portfolio until you. So that's why I'm always trying to emphasize that you have to be into this. It takes time, actually. It's not for, you don't just go in and out in private equity. But if you stay in, it is good.
Well,
I was going to say that people equate private equity to getting to invest in that GP as in getting married. So I'm happy to hear that staying long is a happy.
I agree.
So,
David.
I want to offer an academic perspective on this because, first of all, you take that 1.15 number and you try to annualize it, thinking about sort of the expected duration of cash flows in a fund, you get very close to this 3% number that you're talking about. So you can kind of think about my numbers as saying that there's basically a 3% per annum excess return in private equity over public equity. How should you think about that number? You absolutely should think about it as a premium for bearing liquidity risk. The question is, are you good at bearing liquidity risk or bad at it? Because the 3% is sort of the price that that clears the market. And some people might be very efficient bearers of liquidity risk, and so they view that as an abnormal return because they'd be in the market to earn a 1% premium, but they can get a 3% by investing in private equity. And so it's good. It's good for Roger. It might be bad for somebody else because they're not well equipped to bear that kind of liquidity risk. But I think that's exactly how you should think about this excess return.
And that's where strategies like secondaries are interesting.
Yeah.
Yes. Yeah, I agree.
And you avoid the J curve.
And you can exploit other people's liquidity problems.
And I'm sorry I just happen to have the mic, so I just got to ask.
Cut him off.
When it comes specifically to liquidity, and you have to wait, you've committed it, but you haven't stuck it in yet, and you have to have it somewhere. You touched upon it, but where do you keep it? Is it just in annuities, or where do you keep the money until you have to put it in, because you have to have it somewhere. If you haven't invested in the market, it goes down, you don't have enough. What do you do?
For us, it's very expensive to have this liquidity. We have it in fixed income mainly, but that is due to our mandate. We should be in private equity and venture. We shouldn't be in the listed part of the market. So it's
not by choice they have.
No, because if we would start to invest it on the public market and that would go down and we would come into problems, that would be not good for us. So it has been expensive the last few years.
For someone like us, it's a lot simpler because private equity is just around 5% of our overall asset allocation. So we keep it wherever.
I want to bring up a last point. Maybe, Roger, you actually mentioned it before, and a little bit about the incentives of the private equity team and thinking about what's inside the team and what's driving the team and how that relates to potential time variation in allocations or in calls and distributions. You were mentioning the IRR. You care about that?
IRR is important, but I think distributions is equally important, actually. But of course, I mean, it's part of the game, right? It's everybody knows how this works. It's sort of, you have a fixed fee. There is a fee for there is some sort of carry that comes into play, hopefully, which is more like you actually allocate the positive things about the portfolio between the LPs and the GPs actually. But of course it has an impact. But I think it has a good impact because people don't like to take too much risk by doing hopefully stupid investments at the wrong time if they know that it will actually affect them severely at the end of the day. But I think we can all agree, I'm sure everybody can agree, that we know that the people that works in buyout funds or venture funds, they do it because they like it, but they also think they can actually earn money on it. But they will only earn money if they invest in a good way, and that is actually, they have to think about what they're doing. So I actually think that in some respect the fees has a positive effect on their behavior.
Christina, you want to follow up?
Yes, I fully agree that it's very important. And I think it's, for us, the timing question that is most difficult is when to start to invest in a manager, when to stop investing in a manager. Because if you have the perfect financial track record, first quartile, everything in order, probably the management team has got a lot of carry. And then you can think about the incentives for the next 10-year period. So it's kind of difficult when to start to invest in a manager. And then you also, if you are convinced that the manager is good, you have to be constant over time, because we have a manager in, they are fantastic, but they have one fund first quartile, and the next fund not good at all, and the next one first quartile. And the fund in the middle depends on the first and the last investment was not good at all. And it's just by coincidence if that specific company ended up in the first or the last fund. So you really have to think about the returns over time, over many fund cycles with each individual manager. So timing on fund level is also important.
All right. With that, I would like to close the seminar and thank the presenter, David, and all the panelists for joining us in the discussion. Thank you very much.
Thank you.